All right. Hi, everybody. I am Melissa Garcia, and I'm here to present today's webinar, Help, We Need More Money. When do we never? We always need more money, but we'll talk about a few things that the association can do and some of the limitations and barriers and all that. But a little bit of housekeeping first. On your screen, you will see the PowerPoint presentation in the center of your screen. This should take up most of the screen. There should also be a small box on the bottom right-hand side of the screen with the video feed, i.e. the presenter, me. On the left side of the menu, please select the questions and answers icon and type all your questions there, which will be addressed at the end of the webinar. CMCA credits are automatically generated once the webinar hosting site provides an attendance confirmation report and will be sent via email within 48 hours following the webinar. These credits are not transferable. Please email Summer Sims at ssims@altitude.law or call 303-991-2076 if you have any questions about receiving your CMCA certificates. A couple other things I want to remind everybody about, which is, these webinars, we do 2 or 3 a month, and there's so many topics, so many great things that are coming up. And I just want you to remember to check on our education site on our website. There's a listing now. Instead of having to scroll through everything and figure out what the next classes are, there's a section that just says 2023 events, and it lists all of them. And it tells you whether they're a manager webinar or it's a board class. So please take a look at that. Next week, we have another webinar coming up on February 16th, and that's going to be taught by Deborah Oppenheimer, and it's on animals and their issues. So all that lovely stuff about vicious dogs or emotional support chickens or all that good stuff. And then on February 22nd, this is a board member class. It's a Success Basics for Board Member. I really, really encourage you to have your boards attend this class. It doesn't matter whether they're seasoned professionals or whether they are brand new newbie board members. This class, this board member basics class, is something that helps the board members know the kind of standard of care that they need to follow in order to minimize or eliminate any liability on their behalf, as well as the association. It gives some great practice pointers and tips that the association should be thinking about to keep the association out of liability as well. So it's a really, really good class. I believe Amanda Ashley is teaching that one, and it's from 5:30 to 7 p.m. on February 22nd. And again, that's a board member basics class. So please encourage your boards to go to that. All right, so let's get started. What are we talking about? Help, we need more money. I mean, associations these days, it seems like every time I turn around, we have associations that are in some kind of financial crisis, or they have things that they didn't expect and are looking for ways to generate more income. But obviously that's unpopular when it just comes to raising assessments or doing things that homeowners don't want to do. But at the same time, board members are required, they have the fiduciary duty to make sure that they are acting in the best interest of the association prudently, and making sure that both short-term and long-term, the financial goals of the association are met. They're preserving their assets, they're doing everything they can to ensure the money's coming in the door, as well as spending it wisely, and then taking steps to try to generate more when you don't have enough. So today, we'll talk about just traditional ways that boards will do to create more money or get more money, create more money, print more money. And also the limitations and authority that you get from statutes to assist you with the money-making actions, as well as some of those barriers that might come up with the statutes, as well as the governing documents, and things to think about and be aware of. So when you are trying to use one of these options to increase the revenue, you know what you should also be looking at in terms of what might stop you. And there's a lot of nuances in governing documents and statutes that we need to look at. Then we'll also talk about, in the last couple of years, it seems many associations are hurting for money for various reasons. And so there's some creative ways, and not so creative, but just things that boards just don't know, or managers don't know, that they could do to try to generate more income. So we'll talk about some of those as well. So let's talk about why associations end up in financial crisis. And a lot of these things, I would say, are within the board's control. I mean, it's within a prior board or current board. It's within their control to not get into financial crisis, but for whatever reason, for the poor decision making, only concerned about today's money and not tomorrow's. There are things that they do that they think, well, we're doing a great job. We're not increasing any assessments. No, that's not a great job. And I hope you managers know that when you have a board that's maybe coming to your management company that's been self-managed and they proudly say, we've never increased our assessments, well, that is a red flag, obviously. And you should always be thinking long-term, not just short-term, but long-term as well. And no increase in assessments, that just doesn't even take care of the basic, inflation, not to mention other things that are facing associations today. I would say another inadequate or another poor decision-making option is the inadequate reserves. Reserves, particularly if you're a condo association or a townhome association and you need to have money down the road in order to replace those major components in your community, you need to have reserves. You need to have adequate reserves. You need to be funding those reserves every single year. And it gets really easy for boards to, maybe they look at more popular projects. We would rather beautify the landscaping and then maybe put just a little bit in reserves, or maybe this year we don't put anything in there at all. Or maybe we take from reserves, which is a no-no. You shouldn't really be doing that. But because they're in situations where they have to pull money somewhere else, and then they have to aggressively fund that reserve back. So these are things that are within the board's control. And it doesn't matter that a past board might not have done a great job. Maybe it was the developer that failed to fund the reserves. But when your boards accept that nomination to be on the board, then they need to be looking at the finances and scrutinizing them and making those decisions now that might not have, instant rewards for those decisions, but they will do those baby steps and put them in place so that you can not be in a financial crisis later. And then, of course, there's things that are not under the board's control or somewhat not under the board's control, things like unexpected repairs. I mean, it's a little bit different with deferred maintenance, because with deferred maintenance, you're making the choice to not make those repairs and you're going to defer it till later for whatever reason, or you are prioritizing things. And maybe that in itself could be a problem if you're just continuing to defer the maintenance to the point where not only is it not going to be replaced, it's not going to be useful for its regular lifetime for that use of that component, but it's also just it's shortening the lifespan because you're not maintaining it on a regular basis. So, but unexpected repairs, you really can't do much about that. The insurance deductible, the insurance industry right now is, as everybody knows, kind of going haywire. A lot of the boards I've been talking about, and we'll talk a little bit about insurance and ways you might be able to save money there and change that trajectory. But I know what boards are facing right now, particularly condos. They're required to have one set a budget amount for insurance a year ago, and now it's tripled, quadrupled, whatever. It's just amazing, and it's insane. So, and then also the lots of water intrusion claims that I see coming up as well, and how do you deal with that? You have certain requirements as a board to insure the units, and then you have to pay for all these claims. So there's things that aren't in the board's control, but regardless, there's still things, regardless of whether it's in your control or not, that you can do proactively, and you can advise your boards to do proactively instead of being reactive. I think with COVID, we were living in a world of reacting to everything, where we didn't really have a playbook. We didn't have something that we can take and say, okay, this is what we do. So we're reacting. Well, now knock on wood, that's over. And now we're faced with the consequences of maybe not being able to collect all those assessments during COVID, or being in the situation too, where you can start taking some of these proactive steps to make more money. You just need a little bit of guidance. You need, I'd say gumption and some stamina. This takes time. And so that's another thing that you need to tell your boards, is that to see this through and to try to get the association in a financially great position, it takes time. And there's a lot of things you can do. There's a lot of steps you can take, but it does take time. And just remind the boards about that. All right. So let's also talk about statutory authority. I know that maybe many of the managers that are watching today, that you're seasoned managers, you've been through this quite a bit for a long time, and you know all about Kiowa, and maybe you don't. Maybe you try to ignore Kiowa. It's pretty lengthy statute, and there's lots of nuances and lots of almost micromanaging things, but for best practices for associations. But you should know that when it comes to money, there's not much in Kiowa. I mean, Colorado Common Interest Ownership Act, for those of you who don't know Kiowa and are new, that is a statute that governs most of associations today. And it's split into pre-Kiowa and post-Kiowa associations, just meaning that if your association was created prior to July 1st, 1992, then you're a pre-Kiowa association that is only subject to some Kiowa. And if you were created on or after July 1st, 1992, then you're subject to all of Kiowa. And the reason why I wanted to put that distinction there is because there's certain limitations for certain types of monetary actions that will apply only to pre-Kiowa. Apply only to post-Kiowa and not pre-Kiowa. So we'll go into a little bit of that. But even if getting more money for your association is within your control, there are roadblocks and there are barriers that are found in these statutes. The other one is the Colorado Revised Nonprofit Corporation Act. That also governs all associations in Colorado, and it's more of a secondary statute, but there are a couple of pieces in there, more giving you authority versus barriers. The barriers that we're going to talk about are in Kiowa, but you should know both association statutes, so when you're looking for authority to do a particular action, you might be able to find it right there in Kiowa or the Nonprofit Act, even if your governing documents don't have them. Many documents, many older documents, they might have some unfavorable provisions, but Kiowa might supersede them or assist you if you have silence or gaps in your documents. So just know these statutes. They are in our on our website. So if you just get on our website, on the very home page, you'll see both Kiowa and the Nonprofit Act that you can download. But just know these statutory authorities. We'll talk a little bit about them when we're going through different ways to increase the money in your association. I feel like I should have that Yoko Ono song playing right now. And I thought about it. I didn't have time to get that playing, but I would have played, that I want your money or whatever, whatever. That's all I want. So keep that Yoko Ono song in the back of your mind, and keep the Kiowa books also handy when you're trying to figure out how to increase assessments and all that. So let's talk about the options. Various things you can do. And some of these first three are really just going to be these traditional options that we all can do. And of course, number one is increase your assessments. Now, I know that a lot of boards, they don't want to do this. They don't want to do it because it doesn't make them look good. But as a board member, you have a fiduciary duty to make sure that the finances are good for the association. So you need to increase the assessments. And you need to convince your boards to raise the dues. Back in the good old days, the boards that are of pre-Kiowa associations were able to just adopt the budgets, and that was it. They just adopt the budgets, they send out the payment coupons, and that's all. And you have all the authority in the world to do whatever you want with the finances, and there's no requirement to submit it to the homeowners for approval or any of that. Well, that has changed, and hopefully you know that for both post-Kiowa and pre-Kiowa associations, in order to adopt a budget and have that budget be effective for the next fiscal year, you have to go through the budget veto process. And there is one exception, which we'll talk about here in a second. So under Kiowa, what it says in a nutshell is the board adopts the budget. The board then sends out a summary of that budget to all the homeowners, and then you set a meeting in order to consider the budget. And at that meeting, if a majority of the entire community does not veto the budget, or any higher percentage that's in your declaration, so it could say 67%, but if a majority or any higher percentage stated in your declaration, if that amount of people don't show up in person or by proxy and vote to veto the budget, then it's considered approved and ratified by the homeowners. So that's it in a nutshell. There's little nuances here and there, but just know that even if you were a pre-Kiowa association that says the board has the right to adopt a budget, you still have to follow Kiowa now that says, well, hold on, you first have to submit it to the owners for an opportunity to veto. Now, there is one exception, that's the pre-Kiowa with assessment caps. And essentially that means if you're a pre-Kiowa association and your declaration itself already sets a limitation on the assessment increases. So for example, it says something like, the board has the right to adopt the budget, except if it goes over 10% of the prior years, or except if it goes over a certain amount. Maybe there's an actual dollar threshold amount. If it has those kinds of caps and it says that the board can't move forward if it exceeds those caps without homeowner approval, then that particular association does not have to follow the Kiowa budget process in terms of the veto. What it has to do is just follow its documents. It still has to send out a summary of a budget to all the homeowners. It still has to have a meeting to consider the budget, to have people answer questions and everything, but it doesn't have to submit that budget to the homeowners for a veto, because as long as it's within that cap. If it's within the cap that's stated in the declaration, then you don't have to submit it to the homeowners for an opportunity to veto. You just follow your declaration language. So if it says, if you exceed the cap, then you have to get homeowner approval, well, then that's what you do. But if you're within that cap, then you can go ahead and continue as you've been doing it before, which is adopt the budget, but you still have to have the meeting at which they consider the budget and ask questions. So that's what Kiowa says. Kiowa now applies that budget veto process to both post-Kiowa and pre-Kiowa, except for that one exception I just discussed. But what about the governing documents? I mean, the governing documents themselves could prescribe other limitations that you need to follow. You know what, before I go there, for those of you, you know, the legislative sessions have been so exciting these last couple of years. We have that wonderful 1137 bill that came down. We have all this great language and great new bills that have been signed into law. Well, you know, the legislative session, if you haven't been on our website and you haven't looked at our legislative tracker, there is already some bills that have dropped, one of them having to do with budgets. So you need to get on our website, you need to get on our legislative tracker and look up HB 23-1131. Now this hopefully will get killed quickly or changed because it's a bit ridiculous. What the bill says is the board, before it can even adopt the budget, it's not the veto process anymore. The board has to have a board meeting, and the majority of the entire community, not a majority of a quorum, majority of the entire community has to be able to vote on the budget that the board is approving. So a majority of the entire community has to vote in favor of the budget versus a majority of the entire community is required to veto it or it's deemed approved. So it's completely flips it on the other side. I mean, you can't even get people to come to your meetings. You think you're going to be able to get people to attend and by proxy or person, a majority of the entire community to be able to pass this budget. And if it doesn't pass, then it means the same budget is going to control. So I haven't looked at it in detail because I'm hoping that this is something that goes away pretty quickly, but I just want to drop that little nugget for you to think about. So again, that's HB 23-1131. But your governing documents. So regardless of the budget veto process, there might be some limitations and caps in your governing documents, and they might be stricter than Kiowa. So for example, it might say, even if you're a post-Kiowa association, it might say you must submit the budget to homeowners for approval. If you have something stricter like that or requiring approval versus the veto process, then you have to follow your governing documents. Or it might have limitations on some of the things that you can adopt through the budget process. So it's just document specific. Just remember that. Also, mid-year increases. I mean, typically you have your budget ratification meeting in the end of the year, and then it's good for the next fiscal year starting in January. Well, what if you start the fiscal year in January and then in March, all of a sudden you need to change that budget? And when I mean changing the budget, I don't mean changing how you're spending the money. What I mean is changing how much homeowners have to pay on that monthly basis or quarterly basis. That's a change in the budget that you're going to treat like any other budget process, which is if in mid-year you want to increase the assessments from $100 to $200 a month, you're going to have to go through the same process that you just did with a budget veto process, which is submit it to the homeowners for an opportunity to veto, and follow, have homeowners be able to consider the budget and just treat it the exact same way as you would your regular budget. It's just a mid-year increase. But again, that's more about if you're changing what people are going to be paying, not necessarily the things you're spending it on. I mean, we always talk about the budgets being sort of a guiding tool. You don't know what the specific amounts are going to end up as. It's just more of a projection. But if you know that you're going to have to get more money in the door and you're not going to be able to meet that with the current assessment allocations, then just go through the process again. Okay. Special assessments. What does Kiowa say? Kiowa says a whole lot of nothing. It really doesn't address special assessments, but special assessments are like any other line item in the budget. You're going to be allocating assessments or expenses to the homeowner, so you would treat it, even if, let's set aside the governing documents and just say, let's say your documents were silent. They say nothing about special assessments. If that's the case, then you treat it like, a budget veto, like an amendment to the budget. So using that scenario before, let's say in January, everything's fine. Then in March, all of a sudden you have this huge unanticipated expense and you're going to funding your insurance requirements or budgets for your insurance. And you want to levy a special assessment, but your governing documents are silent, you would treat that like an amendment to the budget. You would do the budget veto process, and you'd essentially be adding this line item for that special assessment, which I know I didn't really talk what a special assessment is about, but what it is just, it's not your regular common expense assessments that are paid on a monthly or quarterly basis, but it's usually just a one-time lump sum that you need for a particular reason during that fiscal year. You might still be giving people 2 or 3 months of time to pay it off, but it's not part of that regular budget. It's something outside of that you are levying in an isolated basis. So if it's silent, treat it like a budget amendment and go through the budget veto process. But I did want to say a lot of times, the documents, especially the older documents, they do have, well, actually, I guess all documents, they do have something that addresses special assessments. So if your documents do have language that address special assessments, then you need to follow your documents. And by documents, it's usually in your declaration or your CC&R's covenants. So you need to follow that. And it could be something, pretty major, like you need to get 67% of the entire community to levy a special assessment. Well, that's pretty difficult, but if it's in there, then you need to follow it unless you amend it out, which we'll talk about in a second. It might actually say that that the veto process is what you need to follow, which is great because typically the newer documents provide that, or we usually write that into the documents. And if it requires the veto process, then it's usually a majority or 67% of the people have to show up to veto it. So if you have that provision, that's great. Then you can just use the veto provision. But some of the documents have, especially the older documents, I'll see specific caps for special assessments. So maybe there's something that says you can levy a special assessment, but if it goes over a certain amount, maybe more than 25,000 or something, then you have to get owner approval. Some of them also say things like, in order to get that owner approval, the quorum requirement for the meeting at which you will try to get that owner approval is higher. I see that in quite a number of older documents, something that says, for a special assessment, you have to get 60% quorum versus your typical 20% quorum. So just look for that because those nuances are things you're going to have to follow. And it's important because the last thing you want to do is think that just because this set of documents and most sets of documents just allow you to do it on a veto basis or on a majority of a quorum approval. Look for that. Look for the higher quorum requirements. Look also for the longer notice requirements, because some of them will say for regular meetings at which you're going to do whatever, it's 10 days. Some might say 15, but for special assessments, I see a number of documents that will say you need to give 30 days notice because it really wants homeowners to have time to be able to show up because this is more important than just the regular budget. So look for that. It's in a lot of the older documents. The other thing that I see sometimes in documents is the scope of use of special assessments. So the way we rewrite the documents, and if you're considering amendment, you should consider this. The way we rewrite the documents is we make the special assessment provision pretty broad. It really should be for things, for any unbudgeted expense, emergency expenses, anything capital improvements, repair. It should be pretty broad because you don't want to be limited in your method of getting that special assessment. And again, when I look at some of the older documents, they're limited in scope. They say you can levy a special assessment for this particular purpose. One I just looked at the other day said you can levy a special assessment to add capital improvements. That's it. It wasn't to repair. It wasn't to take care of emergency issues. It wasn't to fund the reserves. It was for a very finite, just isolated issue. And that doesn't really help because you're not necessarily, typically when people levy special assessments, when boards levy them, it's because it's an emergency or something that was unexpected. So you need to, when it comes to amending, get to that broad language in the special assessments authority. But if you have that in your documents now, you're going to have to follow it. Because again, when it comes to, especially when it comes to money decisions, anything that hits the pocket, those are the decisions that get challenged the most. Those are the decisions that, people are looking how the money is spending. They're worried about their own finances. They don't want to be paying money and then find out that the association is spending it inappropriately. So they're scrutinizing it. And those are the decisions that are scrutinized the most. Anything that hits the pocket. And so, you want to make sure, you need to talk to your attorney, that you're doing everything appropriately on the front end so you don't have that challenge on the back end that, hey, this whole action was invalid because you didn't follow X, Y, and Z. So definitely, particularly with special assessments, because that's the one area where I do see some nuances in governing documents, and they're all different. Also, allocation of assessments. So some of the association's documents don't say anything about allocating special assessments, for example, to just those units that are benefiting from it. So for example, if you have a community with 6 buildings, condo buildings, and let's say only 4 of those buildings have balconies, and let's say you want to levy a special assessment against just those with balconies, because they're the only ones that are benefiting from the expense. Well, you can't do that if your documents don't allow you to do that. And a lot of them are pretty silent. And if they're silent, then common expenses are allocated in whatever default method that or formula that your declaration prescribes. So it could be equal. And that's what most association documents say. Our special assessments are allocated equally against all the lots, or according to the formula. It could be weighted based on square footage or whatever, but that's your default formula. Some documents will allow you to levy special assessments on just categories, just those units that are benefiting or somehow related to that special assessments, but you can't do that unless you have that language in your documents. So look for that. Also look for the approval requirements when it comes to those kinds of documents, or those separate special assessments that you might be able to levy just on those benefited. Because it could be that the special assessment, you only have to get approval from the homeowners that are going to benefit from that special assessment. So just nuances. That's all I'm trying to say, is the governing documents have nuances that you need to be aware of. Okay. Option 3. So again, another traditional thing, I've had a lot of associations lately wanting to consider and discuss loans, and obtain a loan maybe for a particular repair project, or obtain whatever it is. But they're in a situation where they need money and they can't, they don't want to, for example, levy a special assessment, because that means that they might drive their homeowners to bankruptcy, because they're not going to be able to to pay that amount of money over the time period that you give them for the special assessment. So the loans might be a popular way to go, because you would be entering into the loan, and then you would spread that loan out over maybe 10 years or whatever the time frame is. And that way it's more feasible, and people are able to make fund the loan through smaller payments, maybe an increase in assessments, the budget, or special assessments, or whatever. So loans might be attractive. So what does Kiowa say about loans? So Kiowa doesn't really discuss loans. I mean, there is this one section in the very beginning of Kiowa that discusses the legislative declaration that says, this act is being, when Kiowa was first created, it was declaring that for all these reasons, one of them being, it says, the facilitation of borrowing. Associations should be able to borrow, or for all these other reasons, this is why we're enacting Kiowa. So it does say something like the continuation of the economic prosperity of Colorado is dependent upon ... the facilitation of borrowing. But it doesn't really say anything about borrowing within the statute, except for one more about collateral, which we'll talk about. But if you're looking for authority to borrow, first of all, you'll look at your governing documents, but we'll talk about in a second. But there is a section in Kiowa, and it's, you might want to write this down, 38-33.3-302. 38-33.3-3-302. Now, that's an important provision of Kiowa for you to know, because it gives sort of a laundry list of things, default powers that the board has, and not all of them are applicable to all associations. Some are only applicable to post-Kiowa, and the pre-Kiowas are not able to use them, or they might be different depending on whether you're a post-Kiowa or pre-Kiowa association. But those are default powers that the association has, even if it doesn't have that language in the declaration, such as borrowing. So the section in Kiowa 3-302 says, here are your powers subject to what's in your declaration. So again, you have to look at your governing documents to see if they somehow supersede or tell you to do something otherwise. But it's also in the absence of any language in your declaration. So there's nothing that says that the association can borrow under Kiowa, but it does say under 3-3021E that the association can make contracts and incur liabilities. So a loan is a contract. So you can use that particular provision right there. A loan is a contract. And this particular section of Kiowa applies to both pre and post Kiowa associations. Now, the Nonprofit Act does also kick in to bring some default powers. And that particular provision is 7-123-102. So that's 7-123-102, subsection 1. And the Nonprofit Act expressly discusses borrowing. It says that the association can make contracts and guarantees, incur liabilities, borrow money, issue notes, bonds, and other obligations, and secure any of its obligations by mortgage or pledge of any of its property, franchises, or income. So even if you don't see anything in your declaration or any of your powers in your governing documents, you can look at both Kiowa and the Nonprofit Act for authority to enter into a loan. Okay? But then, of course, outside of the statute, you need to look at what your governing documents say in the first place. So your governing documents might require owner approval. I mean, the statutes don't require owner approval for either of those situations. They don't under Kiowa or Nonprofit Act. It doesn't say that homeowners have to approve a loan, but many governing documents do require this as a check or balance against a board from improper spending. So you need to look for that. Some might require a veto. Some might only require owner approval if you exceed a certain amount. So again, it's all document specific. Make sure you take a look at that. But here's the kicker. It's not the authority for entering into a loan that associations have to be too concerned about, because a lot of association documents don't require approval or anything. But the problem is that what do banks want as collateral for that loan? They don't want to mortgage your common elements. So even though you might have authority as a board to enter into easements or mortgages or any of that without homeowner approval, you need to check whether or not, if you're a post-Kiowa association, whether or not you have the right to assign income as collateral for that loan. Because what Kiowa says for post-Kiowa associations only, that in order, this is exactly what it says. Let me see. It's subsection 1N, N as in Nancy, and that's under that 3-302. It says that associations have the right to assign the right to future income, which is what banks want. They want you to pledge your assessments as collateral. So it says that the association has authority to assign its right to future income, including the right to receive common expense assessments, but only to the extent the declaration expressly so provides. So that means if you're a post-Kiowa community and you want to enter into a loan and you don't have the right to assign assessments or future income expressly stated in your declaration, then you're not going to be able to enter that loan, because that's the only kind of collateral banks want. And what I hate to see is when an association has gone through all this process and talked to the banks and gone through, making sure this is a good, feasible option for the association and is ready to enter into these contracts as soon as they can sign the loan documents, only to then come to us and ask for what's called a borrower's opinion letter, which is what most banks want, is a borrower's opinion letter saying you have authority to do this, you follow the proper procedures, whatever requirements they need. And then we look at the documents and we say, did you get owner approval? Because maybe your documents say you're required owner approval. Or did you know that there's no right to assign future income here? And that's what the bank wants. And so at the last minute, 11th hour, all of a sudden you're having to amend the documents to add that right or get that owner approval. So if you're thinking about going into a loan, then make sure that you look at this ahead of time. Once you start having discussions with banks, first of all, you want a bank that works with HOAs. You definitely want to work with somebody who specializes in associations. But bring us in the beginning as well, because we'll be able to position you so that when it comes time to actually sign the documents, that you've already done everything you're required to do to get to that position. And you don't have to give the bad news that, hey, we have to put a halt on this. Okay, so we talked about increasing assessments, levying special assessments, and loans. Let's talk about a couple other things that we're seeing associations do to try to address this, because, it's real easy to say, oh, increase your dues, levy special assessment. But what about all those limitations, those caps we talked about? What about, oh, I hate it when I see a document that says you can only increase your assessments by 5% without homeowner approval. And then it takes forever to get, homeowners are apathetic. They don't want to come to the meetings, and then they don't want to approve any increase in dues. So, I know it's kind of a rock in the hard, between a rock and a hard place, because what I'm going to say is that you need to amend your governing documents to remove those limitations and remove those caps. And I think what you need to do is be armed, first of all, to understand the process with your attorney, get with your attorney, but also understand how to approach this when you're trying to get that approval requirement from your homeowners, because most documents will say 67% of the homeowners have to amend the declaration. And that's a lot of people. That's a huge part of your community. Some might say 51%, but it's somewhere between a majority and 67%. You need to be able to articulate as a board why this makes sense, why it might be pulling some authority from the homeowners to approve assessments, but also the counter is the board's hands are tied, and the board is in the most feasible position to know whether assessment increases are appropriate or not. And if the board is running willy-nilly with these budgets and going crazy, well, homeowners always have the opportunity to remove that board and get a better board in place. But what you don't want is these kind of artificial caps in your documents that don't really take into consideration inflation and all the increases, costs, and everything for the association. So you need to be armed with that when it comes to amending the documents to try to remove this. Because, the knee-jerk reaction is, oh, you just want more power as a board. So just know that. Also, if you're thinking about rewriting your documents, that's the best time, because then it's not just a focus on, we are amending the declaration to remove this 5% cap. It is, we are amending the governing documents to bring them current with Colorado law, to get rid of obsolete stuff, and you have more reason for this to move forward. And it's not so focused on, hey, we're going to pass higher assessments. So the other thing you might want to be thinking about is, if you don't have the language in your declaration for supplemental assessments, well, when you're amending the declaration, then you might want to add that. And for post-Kiowa associations, you are required to have this language in your declaration in order to levy what's called supplemental or individual assessments against less than all units. You actually have to have something in there that says that. Just like the loan language I talked about, the assignment of future income, you also have to have language for post-Kiowa saying that in order to levy assessments against one unit or more, but not all, then because it benefits that unit or those units, you have to have this language in there. So when would you want this language? So a lot of associations, for example, we use the balcony provision. Is it fair for everyone to pay for the balconies if only half the community have balconies? Well, if you don't have the language in there saying you can only levy it against half the community, everybody's sharing in that expense. A couple other things, just chargeback authority. Associations are typically responsible for maintaining not just the common elements, but often the limited common elements also, or exterior portions of the units. But what if some units have lots of huge balconies or 26 windows, and other units only have 2 windows? And is it fair to charge everybody equally in order to fund that expense? Or should we be able to assume the expense and then charge it back to the homeowners, depending on how it's related just to those units? So that might decrease, obviously you can decrease your maintenance requirements. You can amend to decrease the maintenance requirements. But if you want to continue with the maintenance requirements so that the association's in control of making sure that the maintenance is done adequately, but you want to be able to charge it back to homeowners based on their units, then that's one additional thing you can do, is you can add a supplemental assessment. Another supplemental assessment that's kind of popular today is those that are based on maybe activities that are only, or actions that are only related to some units, maybe not property maintenance, but things like, I see pet assessments now. So, you get boards that have to figure out, which owner was the bad owner that didn't pick up after their dogs, and whose dog poop is left here. And they're spending money over and over trying to enforce it against some people, and they don't know who it is. And they know that every year they have to resaw it, or they have to pay for maybe a dog poop company to pick up dog poop. Well, I see a lot of associations now adding supplemental assessment for pet assessments. So if you have a dog, then you are required to share in whatever that budgeted expense is. So instead of having to budget for enforcing violations and trying to do that today under 1137, instead they're looking at changing their assessment so they can charge just against the owners that have pets. Doesn't matter if you're a good pet owner or a bad pet owner, you now have to partake in that assessment allocation. Another thing that I'm seeing is rental income. There's a lot of move-in, move-out fees. If you don't have the language that says that you can charge move-in, move-out fees, then you need to put that supplemental assessment language in your declaration. Or maybe it's just a general assessment that is prescribed against all rental incomes once a year. So these are some ways that associations can add those costs to their declaration. And maybe this is one of the ways where people will approve it, because maybe there's a lot of people that don't have pets, or a lot of people that don't have rental income, but they see that they're participating in these costs, even though they don't get any benefit. So it might be an easier one to pass as an amendment. Working capital fund. This is a very popular amendment that we are drafting these days. And for those of you who haven't been in the business for a long time, or who don't have a lot of older communities, I see a lot of provisions in older declarations that say working capital, and sometimes it's what it's supposed to be initially is money that comes in at the inception of the community to help with the infrastructure, to help with the beginning or the commencement of that community, to help fund some of those costs. And typically with a lot of the older documents, it'll say that upon sale of the declarant to the first owner, there's some kind of non-refundable contribution that has to be made at closing. And then it stops right there. It's the declarant upon the sale of a unit from the declarant to the first owner, a non-refundable contribution, usually it's 2 or 3 worths of assessments, has to be made at closing. So a lot of the older documents say that, and there's no more collecting after that. So it just sort of stops after the community has been built out. Well, a very popular thing that's happening today is changing that, and essentially just saying that upon every sale, every transfer of the unit, a non-refundable contribution has to be made to the association at closing. And so it's, and again, typically it's 2 to 3 months worth of assessments. But the buyer or the seller, they work out who's going to pay it, but somebody has to pay it at closing. And the association doesn't have to credit anything back or whatever, they just get to collect it. And another way that it's different from the old working capital provisions is it's not just for particular reasons, because some of the older documents will say working capital is collected for this particular reason. You stick it in the reserve account and that's it. That's the only way you can use it. If you are amending your documents and putting in some of these favorable tools, one of them will be the working capital fund, and the fact that that can be used however the board wants to use it. Because again, the board is in the best position to know what's appropriate, what the community needs. Do they need to increase their reserves? Can they use it for unbudgeted operating expenses? So whatever it is, again, like special assessments, the language for a new working capital provision would be applicable to all sales and would be broad in use of scope. So that's something that you might want to look at as well. There's actually something in Kiowa that speaks to it as well, these transfer fees. And I think, I can't remember the percentage, but there's language in Kiowa that says that you can charge based a percentage of the sale. So I think it's up to 3% or something. So most associations don't have that because that's hard to sell. That's hard to sell to a community that, hey, let's say your property is worth $500,000 and then you're charging $10,000 or whatever for at every sale. That might seem great to get that money in the door, but to be able to sell that type of an amendment to the homeowners who know that, you know, we're going to have to build that into our price for selling the unit. That's kind of hard sell. So most of the time I see something like 2 to 3 months worth of assessments. And if you have a lot of turnover, it's a great way to generate more income for your association. You shouldn't rely on it. You shouldn't be using it and saying, well, our budget is relying on this. It's just more of extra money that's sometimes a great surprise depending on how many units turn over. So you should think about that. Okay, insurance. We talked previously about insurance issues. Just the scenario that I'm seeing all the time now is associations, particularly condos or townhomes, they're required to insure the unit. Kiowa actually requires post-Kiowa condos to have minimum insurance requirements. That's both the common elements as well as the unit, but you can eliminate the finished surfaces of the perimeter walls, floors, and ceilings, and you can also eliminate the improvements and betterments and upgrades of the owners. But if you're a post-Kiowa condo association, the minimum insurance requirement is pretty much original construction. It's the unit itself and the common elements, and the only thing you can exclude is for finished surfaces of perimeter walls, floors, and ceilings, and improvements and betterments and upgrades. So that's a difficult. It's difficult, particularly when we have these water intrusion claims that are ongoing. And that's sucking in a lot of your income if you have to keep filing claim after claim after claim. So a couple things you want to do. So if you're, first of all, if you're a post-Kiowa, any Kiowa association that you want to reduce your coverage, I mean, maybe you're a townhome community that is not required to have these minimum insurance requirements, and you want to go from maybe you have all in, which is you have to insure everything under your declaration, the unit, the upgrades, the betterments, the finished surfaces, all of that. And you might want to, amend your documents to reduce that coverage. So you can certainly reduce the scope of coverage to the extent that you can. Again, post-Kiowa communities, they can only reduce it to a certain amount. But the other thing you want to think about is how much does it cost to typically handle these water intrusion claims? Because one thing you can do is both reduce the scope of coverage, and then also, this takes a lot of communication with the homeowners, but also change your deductible amount, make higher deductibles for your association property policy, and increase it to a number that's above the typical water intrusion claims. Because if, let's say, the typical water intrusion claim is $25,000 or $20,000, and you have a $5,000 deductible, well, you're going to have to file an insurance claim every single time because the amount of repairs exceeds your deductible. If you increase your deductible to $30,000, then when a condo unit owner has damages to their unit and their insurance adjuster says, oh, look, the association has primary insurance, this is the association's responsibility, they're required to cover all these, turn it over to the association. You can then turn around and say, no, because the estimated cost of repairs is less than the deductible, so there's no insurance proceeds because the cost of repairs is less than the deductible, and you can shift it right back to the owner's insurance. So that's a really key way. You got to figure out what your claims history is and how much, what's that average amount, and then increase your deductible on the property insurance policy and maybe reduce the scope of coverage, so that every time it gets kicked to you, you can kick it right back and say, nope, it's less than the deductible. There's no need for the insurance to kick in from the association, go straight back to the owner. And also just the deductible allocation. Make sure that you have language in your documents that allows you to allocate the deductible in situations where maybe negligence, so that the association isn't having to absorb that deductible as well. So that's another piece of language. Short-term rentals, I see a lot of associations today that are kind of saying, we want our cut. They know that people want to monetize their units, not trying to eliminate the Airbnb. Instead, they're just saying, we want our cut. So sort of like the rental income before, they're saying, okay, Airbnb, yes, you can do the Airbnb, you can do the VRBO, but every time you do that, we get a share. We get some kind of fee. So you can write that into your documents. Going green, I know that, there's a lot of ways to maybe save money through going green. So some adjustments or repairs or water saving techniques to the property could help you reduce the costs. And there's also grants. There have been grants. I know there used to be a grant with the state. I don't know if it's still in place, where if you demonstrated that you were going green, then you could qualify for some of these funds. I know a lot of cities have grants and programs that show that if you're trying to go green and you're going xeriscaping, for example, that might have a lot of upfront costs just to xeriscape, but then you're getting rid of all that water cost. So there's ways that you can go green, go paperless, and absorb some of that or decrease some of the costs again over time. You might not be able to see it right away, but it is something that you can put in place to save some money. A lot of people don't know that under Kiowa, you can charge a reasonable amount for use of the amenities. You can rent out your clubhouse. You can actually just charge homeowners, even though it's kind of an unpopular thing that people are paying assessments to use the amenities, and then on top of it, you're charging it. But honestly, when you're looking at something, ways to address this and get more money in, then here are some of the tools that you are allowed. And this is under that same section, that default section of 3-3021K. It allows the association to charge for use of amenities. So you might have, I don't know, I guess most people have problems with parking, but if you have extra parking spaces, then you might, or maybe there's storage places, or maybe you have some unused property that's vacant that you might want to maybe lease out the storage spaces or lease out the parking spaces, because most governing documents allow the association to enter into leases for the common elements. So just creative ways of trying to fund the association more appropriately. So obviously cut down on spending. I got to read this meme that I was preparing for this class this morning, and this is what came up on my Facebook this morning. What does it take to waste $10,000 a year? The answer is just $27.40 a day in miscellaneous spending. I bet you if you looked at all your expenses and looked at things that, maybe you don't need anymore, or maybe you can cut corners here or there. Look for ways to reduce expenses, and you'll never know it unless you really sit down and prioritize and take a look at all the expenses throughout the year. And there are ways to cut corners, but you just want to make sure you don't cut corners to jeopardize the community's well-being. You're not going to want to not make the playground repairs and put children in danger because you want to cut some corners. You want to cut corners on things you can compromise on, but you need to just sit down and take a look at that. You might be able to renegotiate some contracts. I mean, I think that with especially right around renewal time, and the contract's up. Maybe you are a long-term customer. Maybe you can get some kind of loyalty discount. You might be able to renegotiate prices, or you might look over your history and say, well, we really didn't need all that. Here's the 5 years to show that we don't need this premium, whatever it is, and renegotiate that. Some associations are putting ads in newsletters. This really probably helps a lot with the bigger associations. If you have a community newsletter, you have local businesses that might want to advertise because they know they have an increase in reach. Some of those local businesses can put in ads or coupons. You might want to look at that. Other things. I see some associations that are a real popular one I've been seeing lately. We've been getting the question of what can we get rid of lifeguards? I know lifeguards are really expensive, and that's a huge expense for associations. I mean, I think that there's nothing in the statute that says you can't not do this. There might be some within your community, there might be some, or county regulations that you have to follow in terms of how large the pool is, and maybe there's no way to get around this. But if you're able to get rid of the lifeguard expenses, you still want to do things like circulate and create some sort of policy or rules and regulations for unattended pool use. You're going to want to talk to your insurance carrier for this and see, what kind of coverage you need. You're going to want to have some kind of liability release that's incorporated into those rules and regulations. You're going to have to post several unattended swim at your own risk kinds of requirements. And again, of course, verify your local municipality ordinances and see, what might be required there. And so there might be other things, that you can think of, but those are some. I Googled, and there was a lot of things. I mean, some are allowing a cell tower on your roof. I've seen that. Having homeowners do some of these projects, and I've seen that. So it takes a lot of time and consideration, but here's some additional considerations. If you are I'm really looking at that second one, combination of options. Oftentimes you can't do just one of those things, like get into a loan or whatever. It's a combination of all these options to try to increase the coffers. And you make a prudent, informed decisions that allows you to your boards to eliminate any liability on themselves. They've paper trailed that they've asked the questions of their attorneys. They have made informed decisions. They know that these are the processes for levying a special assessment or doing a loan. Lots of the communication to the homeowners, because oftentimes there's that wall that comes up that if you're trying to do something that costs money, there's a knee-jerk reaction that, no, we don't want to spend any more money. But if you know the numbers ahead of time, you bring your experts to the meeting, your loan expert, your attorney, your construction expert, whomever, to the meeting to explain it for them and for you, and to show why this is a good idea and how it might be, upfront cost, but it's going to save money in the long term. It's a good thing. I mean, use all of this when you're trying to use any of the actions we discussed or any kind of new things. And I think that is it. Questions? So I'm right at after 2. I'm sorry, I'm after 1 o'clock, but we'll go ahead and take these questions. And for those of you who have to go, thank you for attending. I will... You can certainly leave, but I will go through. There's a lot. Okay. Hi, Melissa. Hi. In pre-Kiowa, a property where you don't exceed the cap that's in the deck, but you're also not increasing any dues, can the homeowners veto the budget and ask the HOA to fund reserve funding and increase dues? Well, the homeowners, if there's no change in the budget, then there's no veto. Okay, so there's no requirement to have a veto. But if there is a change in the budget, and you are a pre-Kiowa community that has that cap language, then it's up to the board to make its own determination. The homeowners can't say, you must do this. You were elected, or your board was elected to make those decisions for the association. So if you're in a pre-Kiowa community, you have the cap language within your documents, you're not exceeding that cap, the homeowners can't make you do something with that budget, change it, or make you put it in some kind of reserve. Now, what the homeowners can do, if they don't like what the board is doing, is remove the board. That's always the remedy if they think that the board's not doing a good job. But just to say, hey, we want to vote on this, it's not appropriate for the homeowners. The boards take action on behalf of the association for everything other than what's specifically reserved for the homeowners to a vote. And if it's not specifically reserved to them for a vote, then the board makes a decision. So it doesn't raise dues. It is a large chunk they owe. I don't know what the question was there. So maybe if Kelly, you want to rephrase that, then I'll answer it. So here's the next question. Pre-Kiowa with a 3% assessment cap, falling behind inflation every year. Can we do a special assessment beyond the 3% as a budget amendment? So if you have a 3% assessment cap, then, and it says anything over that 3%, you have to get an owner approval, then you have to get owner approval. Follow your documents. If it says that you can't, if it doesn't specify approval, and you're, you can try the budget veto process for an amendment to the budget. You can certainly do that. You can also, and this is what I would stress, is to get rid of it, because you're going to be facing this problem every year. And I know that it takes a lot of time to amend the declaration to try to get rid of some of these caps, but just once you do it one time, it's going to save a lot of stress and a lot of cost and energy for the association. So it might be a lot of upfront cost to amend the declaration and energy and going door to door to get this passed. And there is even also the court petition process. If you can't get people to approve it because of apathy, not objection, there's a way to get the court to approve it. But I would spend my energy on that. But if you exceed that 3% cap, then you're going to have to get owner approval, because that's and whatever your documents say, it might be something terrible like 67% of the entire community, or it might be something a lot easier like a majority of a quorum, but you still have to follow that. An association has a potential special assessment on the horizon because homeowners keep vetoing increase in assessments. How can the board encourage owners to see the damage they are causing? Well, that's what I meant about having the numbers ahead of time. I think you need to sit down and look at your history and look at, maybe you have a chart that says, hey, if we would have done a special assessment here, we wouldn't have had to do X, Y, and Z to pay for the repairs. We wouldn't have to defer that maintenance. We wouldn't have had to spend this amount of money because we were able to increase assessments. You have to show that that's where most of the leverage is showing clear numbers and how this is going to save them money in the future. Instead of spending, $10,000 a year, they're spending $50,000 because they weren't able to do that assessment increase. If you're able to show those numbers, and that's going to take some time to review and look at the history, that's probably the best way to encourage homeowners. Or just go door to door. You have to have a lot of, not just the board, try to get a budget committee together, try to get some homeowners to volunteer. I know that's hard, to put together a task force to say, hey, how can we save the association some more money? Maybe we shift a lot of maintenance to the homeowners. They might be much happier knowing that they have to pay for that balcony maybe only once every 10 years versus every year they're paying a little bit for everybody's balcony. It's just giving them those scenarios. Reserve analysis study, maybe. Yes, definitely. The way to prevent those large special assessments is to fund your reserve. Get a reserve study. That's the only way you're going to be able to figure out how much you need to put in every year. Make that like breathing. Make that not a scary thing of funding the reserve. It should be an automatic funding into the account. We know that last year there was that reserve bill that got vetoed at the last minute. It's probably going to come back today, this legislative session. Just be prepared for it. So just get your audience and get your homeowners aware that this is necessary. You don't want a Surfside issue to happen. A board would like to issue a $500 a year special assessment only to owners that short-term rent their unit. Is this possible? Only if you amend to allow that. So you're going to have to amend the declaration to prescribe these supplemental assessments that are only going to than all owners. It has to be stated in your documents. You don't have authority to just make that decision as a board. If the association has provided trash service, can they take that away in effort to save money and bring light to the financial situation? The documents do not say that the HOA would provide the service. So if you're not required to provide trash service, you can certainly then shift that to the homeowners and go that route. But what I wouldn't want you to do is, if you are, when I said to discontinue services, you don't want the situation, a health safety kind of situation where people are don't have their trash being taken out. I mean, I think that's more of an extreme than getting rid of some other kind of amenity or service just for a little while, and then maybe once the financial position is better, reintroducing those kinds of amenities. But things like trash and water and things that might result in health safety issues, I probably would refrain from doing that. But certainly if your documents allow you just got to take into consideration what that means, and shifting that back to the homeowner so they can pay for their own trash, that might work. But make sure your documents don't require you to provide that service. What legislation do you think will be proposed this year related to reserve plans and reserve funds? Probably something similar to what we saw last year. And if you get onto our website under the legislative tracker, it's at the top, we have the last, I think, 4 or 5 years of legislative bills on there. So look at the 2022 legislative tracker and open that up and take a look at they're categorized by the names of the bills, and you'll see the reserve one. Take a look at that. It's probably going to be something similar to that, maybe not as extreme as it was, but the governor, when he vetoed it, did say that this deserves more attention and more thoughtful, rewriting of the bill. But I think it will be introduced again. Could we please have a list of all references? We didn't catch many during presentation. Do you mean the references to the Kiowa provisions? If so, I will send out a list of the Kiowa provisions that we addressed and the Nonprofit Act provisions that I addressed, and make sure that goes to everybody. If it's something else, just contact me offline so I know what you're talking about. If you need a reference for an HOA attorney, I'm available. If an association can assign future assessments, couldn't that jeopardize being able to fund your operating funds on a monthly basis and your reserve for needed repairs or replacements? How do you handle this situation? Sure, if you're not spending or saving appropriately, and if you're not making an informed decision, it could jeopardize. But that's why you don't want to enter into a loan unless it makes sense for your community. And maybe you don't want to enter into a loan for a huge amount. Maybe you want to combine it with increase of assessments here, loan over here, cutting some kind of costs over here. I think it takes a lot of thought and a lot of discussion with the banks to make sure you're doing the right thing, with your attorney to make sure that you understand the future consequences and that you're going to be held for the next 10 years to fund this loan. So yes, I mean, it could, like any other expense, could jeopardize monthly operating expenses if you don't enter it into that action wisely. Is a supplemental special assessment you mentioned the same as a limited assessment? Yeah, I see it's called different things. Sometimes it's called a supplemental assessment. Sometimes it's called an individual assessment. Sometimes it's a limited assessment. Sometimes it's not even called an assessment. Sometimes it's just you have the right to charge back expenses to the units benefited. And that's all it says. So don't look for the wording. I mean, it might not be there. Just look for the language that allows you to charge assessments on a non-community-wide basis. That's what you're looking for. And if you don't have any of that language and it makes sense to amend, then we would be adding that supplemental or individual assessment. Can the HOA, what's a reasonable amount to give the HOA for a rental cut? I don't know. I haven't seen. Typically, you should talk amongst each other or see what, I don't know. I honestly, that's a great question. And if you find out after talking to realtors, maybe you tell us. But typically all we do is we put in the language saying they have authority to charge. So maybe it's a percentage. Maybe it's a percentage of what, maybe it's just a flat dollar amount. I don't know. I'm sure whatever it is, you can, when you're talking about reasonableness, remember you're amending the documents to get that in there. So if it's something really out of whack, like you make $10,000 and they only make, they give you $10,000 and they only make 5,000 or something really out of whack, you're never going to get that passed. So remember, when you're amending, know who your audience is and know how many people are renting on a short-term basis, because that's going to be one of the challenges. Can the HOA adopt a policy to charge a percentage that have STR, or does it have to go before the ownership? It has to go before the ownership. I mean, this is something that is an amendment that you have to put in your declaration. It's not something that you can adopt a rule or a policy saying, now we're gonna charge a percentage for short-term rentals. You have to amend your declaration to give you the authority to charge. Now, what I wouldn't do is amend the declaration and say you will charge X amount, because if you do that, then every time you want to change that, you're going to have to amend the declaration again. Instead, you put the broad authority in the declaration to charge the cost, and then you allow the board to determine that cost or percentage or whatever in your rules and regulations or leasing policy that is supplementing or defining that general authority. Subfloor repairs are going to bankrupt one of my associations because they are not addressed in their old declaration pre-Kiowa. So it's assumed that it's an HOA responsibility. If the declaration does not have any provisions about limited assessments, there is no way to charge back. Yeah, there is no way to charge back, but be careful, because sometimes you don't see that language, supplemental assessment, or that header or that title, individual assessments. Look for language that says you have the right to charge back expenses to less than all owners based on X. That's what you want to look for. And also you might want to consider, amending. If you're going to consider amending, you might want to just amend to shift some of those maintenance costs. That's a big thing too. Shift some maintenance costs to homeowners, and they might actually like that amendment because they'd rather just pay for their own repairs versus having to pay for everybody's repairs. And it might be cheaper for them. So you might want to do that. Regarding STRs, we need our share. Can this language be written in ACC ARC requirements regarding businesses? You can draft pretty much everything. You can craft that language and put it in your declaration, but it's only if you can get that declaration amendment passed. So yes, you can tie that. I just gave you some examples of the pet income or the short-term rental income. There are other ways that you can fund the association by putting the appropriate language in the declaration, but remember, you have to get homeowners to approve it. Same question as above. Pre-Kiowa never added maintenance of roads, and 50 years later, the county claims they were never accepted, and the HOA needs to maintain them. Limit on assessment. Can this expense be added to the budget? Yeah, there's, if it is a common expense of the association, which is pretty much defined as any expense of the association that the association is required to do, then sure, you can add it to your budget, but you're going to have to go through the budget veto process, or even approval if that's required, or if it's over a certain expense, you're going to have to follow your governing documents in terms of adding it to the budget. But yeah, if it is a common expense of the association, even though you didn't know it, and then now you've discovered, I would talk to your attorney to make sure that the city's saying the appropriate thing. I would make an informed decision, have an attorney take a look at it and make sure, yes, this is valid. You do have to maintain those roads. After that, again, you're paper trailing that you are making an informed decision. After that, then sure, you can increase your budget, but you're going to have to go through the veto process or potentially approval. If you have to call a general meeting to vote on the special assessment, can you provide notice with at least 10 days and not more than 50 days as specified in Kiowa, even if the HOA declaration says you need to give 30 days notice? No. So Kiowa provides the general minimum timeframes for notice. But if you have something stricter in your declaration that, for example, requires more notice, you have to follow your declaration. And that's one of those amendments you might want to get rid of. You might want to get rid of the increased notice as well as the higher quorum, because that usually comes hand in hand. Can a special assessment be used to fund reserves? Potentially, yeah. And that's where, when we talked about looking at the specific language of your special assessment provision. If your documents are silent, then there's no limitation. If your documents say special assessment can be used for these purposes, then you're limited to those purposes. So again, if you've got old documents, you really should be thinking about rewriting them to get in some of these tools and options. Can an association do a mid-year assessment before the mid-year and name it a mid-year increase? Yes, you can do. You can call it a mid-year increase because it could be March and maybe not really get going until June. So yeah, you can call it what you want, but I mean, I wouldn't say it's a mid-year assessment increase if you're doing it in November. So. Okay. Oh, one more. In our area, STRs have to register. Every time I see STRs, I see STDs. There's something wrong with me. So in our area, STRs have to register with a local government, but that info is not publicly available, and owners lie and say they don't rent when they do. Anyway, a way to find out that information in Colorado. I mean, it's if people are sneaking. And, I know some cities have licenses and maybe they do show, who's registered and who's licensed and who's doing it. I don't know. You're going to have to look at each of the separate ordinances and regulations and look at the specific requirements. It's always hard to monitor any kind of rental requirement or provision because people can lie. So oftentimes you're just hoping that you can get a witness to let you know that they are renting, or maybe you look at they're never there and they have an offsite address. I don't know. There's a lot of different ways that we can be the sleuth, but talk to your attorney. You can only do what you can do, but there are ways to find some of this information out, and that could be through the city, maybe not. Okay, I think that is it. Thank you so much, everybody, for joining me and staying for 20 minutes afterwards. I'm sorry that I took, there's a lot of questions. I really appreciate everybody attending. And again, don't forget, next week is all about animals. I know that that's a big problem. And then the Success Basic for board members, February 22nd, 5:30 to 7 p.m. Thanks, everybody. Bye-bye. Go get some money. Now is when Yoko Ono should come in.